Hello everyone, welcome back. I got some really good ones for you this evening. It's Tuesday, August 22nd, 2023. Glad you made it. Lots been going on in the markets and we're going to focus on that for this evening. So we're going to talk about the 10-year yield, fear coming out of China, developments coming out of the Jackson Hole Federal Reserve Symposium this week, and those are kind of, going to be driving the headlines, kind of driving the markets short term. Driving those algorithms when those Fed officials speak, my gosh. So let's dive right into it. The 10-year yield right now is at like 4.3%. The stock market doesn't like it there. The real estate market doesn't like it there. No, pretty much causing a pan sell-off and everything. So what you're seeing is the 10-year yield moving up past 4%, up to 4.3% in a relatively short period of time. And that caused the bond bubble to kind of buckle a little bit. And then the other markets, like the smaller real estate, stock market, crypto market, energy market, precious metals markets, Squishmallow, Beanie Baby markets, Pokemon card markets, baseball cards, they all saw the bond bubble begin to buckle, and they were like, oh my gosh. And so it kind of created like a pan sell-off and everything. The 10-year yield moved up too quickly. The dollar on a relative basis got a lot stronger in a relatively short period of time. Interest rates moved up even further. That kind of pushes those risk assets down. And then you have fear coming out of China. Evergrande, which went bust in 2021, is now like looking like they're not going to be able to restructure. It's causing kind of an implosion in the Chinese real estate market. We're seeing the Chinese real estate market take a hell of a walloping, and that's kind of creating a domino effect through the Chinese markets, and then the US market's kind of like, whoa, and as the central bank of China moves to weaken the yuan, drop their interest rates, kind of try to prop their markets back up, I think that weakening yuan relative to the dollar kind of forced a lot of traders and money into the dollar at a time when the Fed's also coming out this week and supposed to be talking hawkish and talking more interest rate hikes. So you kind of add it up, and the markets are just kind of in a tizzy right now. But really, I'm not freaking out at all. If anything, I think the NASDAQ, which was like 15,000 in July, got like, the three major U.S. stock indices got pretty ahead of themselves over the summer, which is interesting because for a smoking hot July and a pretty frothy, bumpy August. Usually summertime is the summer doldrums, kind of low liquidity. Everybody's out of the office, kids are out of school. So, this summer has been pretty wild, and I think we're giving some of the gains back. So I'm not really freaking out too much. The Fed could come out hawkish this week, which means they're going to talk about more interest rate hikes, more paltry 0.25% hikes to the Fed funds rate, and that's to like win the war on inflation. You know what I mean? Laughable. And it's by design they're losing their war on inflation. But they could come out and really try to prop up the dollar, prop up the economy, ignore the financial system, focus on inflation being a real problem, focusing on the standard of living of your average American getting beaten up pretty good. If the Fed were to come out and talk hawkishly and really support the dollar, well, that could send these markets even further into a tailspin, meaning the stock market, the real estate market, the precious metals market, all of those markets, crypto, could all, really start to sell off if the Fed comes out hawkish this week. But if the Fed comes out kind of dovish, like, oh, well, we're concerned about these bank downgrades, we're concerned about what's going on in China, we really are happy to see inflation coming down on its own, we don't really know if we need that many interest rate hikes going forward, well, that kind of dovish talk would really support markets. So those are, three things that are kind of driving traders short terms and headlines on the short term. Bond yields being too high, FUD coming out of China, Fed officials meeting this week. Are they going to be hawkish? Are they going to be dovish? That's really all the fear, uncertainty, and doubt you're seeing right now. Otherwise, though, markets are hanging out pretty close to all-time highs, but still a little bit of fear reverberating through the market. Still some things that I wanted to address with you guys. What do I think's going to happen? And this is just my opinion. I could totally be wrong, and nothing is a buy or sell recommendation. But I think the 10-year yield's going to start coming down, and I think that's actually going to push markets back up. Because if the Fed were to or somebody were to start buying bonds, the Fed, driving bond yields down, propping up the bond bubble again, that strengthens bank and institutional balance sheets, and it makes them kind of want to take risk again. It kind of raises the opportunity cost of holding a bunch of bonds. Put another way, financial institutions look to start buying stocks, going out further onto the risk curve. So if bond yields come down and the bond bubble gets propped back up, that should prop the stock bubble and all the other bubbles right back up. And if you're like, well, that's optimistic of you to think that, I'm not even being optimistic. It's horrible for the middle class. It's a problem in and of itself. It's a real problem for the dollar. So it's not like a good, bad, I want to see the stock market keep pushing all-time highs while the average American just gets crushed by inflation. I'm just telling you how the debt-based monetary system, is probably going to react to all of this. Meaning, I think, if anything, pretty soon, those bond yields are going to start coming down. Those interest rates are going to start coming down. That dollar's going to start weakening, and it's going to prop up the stock market, energy market, precious metals, crypto, whatever. So I actually see that happening. But if I'm wrong, then look for that 10-year yield to keep marching towards 4.5%. And if it's like 4.4% tomorrow or the next day, look out below for stock market, real estate price tags, right? Because those yields and rates and mortgage rates and dollar are going up and starting to really push down on real estate price tags, push down on precious metals prices, push down on crypto. So that's really, the possible scenarios I could see playing out. But I'm leaning bond yields start to come actually down. And if bond yields drop back down below 4%, dude, that's really bullish for markets. So, when that 10-year yield popped above 4%, the bond bubble was like, I think I'm gonna get sick. And then the stock market was like, and then it created a vomit chain reaction, essentially, a pan sell-off, which I have witnessed a vomit chain reaction, in person. I've seen that before, but that's a different story for a different day, all right? So yeah, I just wanted to tell you what was going on with the markets, and I pretty well laid it out for you. Pay attention to the Fed, pay attention to what's going on in China, pay attention to that 10-year yield, pay attention to interest rates and the dollar in relative terms, like the dollar chart. And that should give you a pretty good indication of what's going to happen to the stock market, real estate market, precious metals, beanie babies, you get the idea. So that's really all I got for you guys for right now. Pretty quick video. I hope you're doing well. I hope, what's up. Just shout out to everybody that we're really building something cool here. So it's fun. I really like hanging out with you guys, and we're just going to keep going. All right. Till next time.